Welcome to video 10-1, where I begin responsibility accounting from chapter 10. So in this video, I'm going to go over the general idea behind responsibility accounting as covered in this chapter specifically. It builds on an idea we've been cultivating the entire textbook. But we come down to some real brass tacks here in this chapter. And we'll go over one specific tool that ensures responsibility accounting can work in our service department cost allocations. So first of all, I have some fun with my GIF here. I found this picture, this myself, and I took pictures of it because I thought it was funny. Hey, look, the market clearing price for Ready Player One videos, $0. So the idea here is that responsibility becomes especially important when you have large firms. In smaller firms, responsibility can be ascertained in a less formal way. You have people who know directly who's responsible. The decision makers are known to the bosses, and so on and so forth. So it's more closely knit. It's like a small town, you know. The great thing about a small town is it tends to be close knit. The bad thing is that everybody knows your business. It's hard to dodge responsibility when a smaller firm. When you start getting larger and larger and larger, you have to do a few things. One of them is decentralize the decision rights, because optimally, in almost all circumstances, decision rights need to follow where knowledge is. Whoever has the strongest knowledge about circumstance needs to be invested with at least a good portion of the decision rights associated with that circumstance, because they're going to have the best information for this. This is why, centralized planned economies don't work. They remove the knowledge power of decentralized information, of all these individual people together building the magic of the invisible hand described by Adam Smith. Individual people taking on using their own information, which accumulates to a lot more than can be centrally amassed in one central location, and taking on their own risk as they judge fit based on the information that they have. So all those things happen in a microcosm way within a firm. Analogizing between a large-scale economy and a firm. So as you become a larger firm, you need to have more and more decentralization. So the story I often tell in class is the idea that you start up a hot dog stand, and it's just you and a cart and the hot dogs. And so you start out, you're really good at this for some reason. I don't know. You're really good at it. And so you decide, I want to, now I'm going to have besides just having my cart that I wheel around, I'm going to go ahead and get a little restaurant. And so, okay, I'm going to invest some money. I'm going to take on some risk because I'm going to have a lease that I'm committed to and costs money to cancel. I'm going to buy the thing outright, the location for the restaurant, have fixed expenses for the debt that I have to buy it. And anyway, you have these fixed expenses you've got, and you also are going to probably get some workers. You're not going to man the whole restaurant yourself. So you have some workers as well, but you're still in the mix, and you still, just like when you were at the cart, you knew a good deal about when you bought hot dogs and what made the hot dogs really good, when they were a good supply of hot dogs, which suppliers are good. Maybe a little less now, actually. Maybe you're a restaurant owner, you have a variety of things you're dealing with, and perhaps you've hired somebody to help with the sourcing. Okay, so but you still know that person. You still can talk to them. Well, how are the hot dogs right now? Oh, they're hot and doggy. So yeah, they're doing great. You also now when you're in a restaurant, you have this hot dog restaurant. You are still engaging with the customers, at least on some degree. You still see how they're reacting. You still see what's selling well, what isn't selling well, which hot dogs are not so hot. How many more puns can I fit in about that? But the idea is, you still are relatively close to the customer as well. Not as close as you were when you had just the cart, because you were the only person interacting with the customer. There was no one between you and the customer then. Now that you own the restaurant, actually the shift manager and the waiters and waitresses are closer to the customer than you are. But you still most likely have some interaction, or you know those people. You can go talk to the manager, or you can go talk to individual waiters and waitresses and see what their reactions are and how the customer, engage how the customers feel that way. Well, let's say your restaurant does really well. Now you're in stage 3 of this little story, and you decide, let's just make this into a chain of hot dog restaurants. Well, okay, Now you're running a chain of hot dog restaurants. It becomes less and less likely that you are clued into the details of the sourcing, the hot dogs coming in, the condiments, different, and as well as that you're. It's less and less likely also that you're going to be clued into what the customers are doing, at least with that down to earth ground level information. You can see data that will help tell you, but the data is only going to tell a certain part of the story. It's going to have certain types of measurement issues and limitations to what it can tell you. It's not the same level of information that you had when you were the hot dog cart runner. You ran this hot dog cart. So, as you get bigger and bigger, the owner of the firm, you, know less and less and less firsthand. And you get more and more through the structure, the organization, the management, the accounting structure, and the system that you have. So as the owner of a chain of hot dog restaurants, you're likely to get reports. But there will be reports on a monthly or quarterly basis, and they'll be comprised of a certain class of information that probably is pretty good. Accounting information tends to be the most important stuff. We try to make it the most important stuff. Accountants tend to be pretty smart about this. But again, it's still not the same type of information. It's not the full picture that you used to have. And so what's likely going to happen is as you get further and further away, you are endowing the people below you with additional decision rights. So you are decentralizing some of those decisions. When you were in the cart and somebody, came up to you and wanted a discount for some reason, or hey, I'm going to buy 5 of them. Can I get $1 off? You made that decision yourself. When you owned the restaurant and somebody didn't like their plate, they want to send it back, which is another way of kind of getting a discount, rightly or wrongly. Perhaps the person really did have a hot dog that was made of cat or something instead of dog. I don't know. But, you have somebody else making that decision is the point. The waiter, waitress, or the manager is making the decision of whether to refund that meal. And so now, okay, we have given them decision rights. And as you become the manager of several restaurants, now the individual managers of those restaurants, the people who are overseeing each individual restaurant, has those kinds of rights. And you have an extra layer between you and the people making that decision. So more and more decisions need to go down to the people who have the information and are close to the decision, so they can feel the ramifications if they make a wrong decision, for one thing. All right, so anyway, we have to decentralize decision rights. And in a bigger firm, therefore, we also need to make sure we are pegging responsibility for those decision rights. We need to keep people accountable for the decisions they're allowed to make. Again, big problem in big organizations or big governments as well. The idea that you have people who are kind of the nameless bureaucrat. This happens in both situations. It's not just a government thing. It happens in big firms too. The nameless bureaucrat is making decisions and is separated enough from the effects of those decisions that they make really bad decisions because they don't feel any impact of that. Either the government's part of this analogy because they were never voted in the first place, and so they can't get voted out, or in the business side of it because who is tracking the information, the responsibility to them. And so, here we go. This chapter is where we're going to start talking about 3 key tools that help you peg responsibility to decision rights. And you had to decentralize decision rights because knowledge had become more dispersed in a large firm. All right, there's the logic for what we're doing. It's called responsibility accounting because now we tend to call this area of accounting responsibility accounting, even though we've been building up to this since the beginning. I said at the very beginning, you want to hold people and things accountable and responsible for the costs that they have from the profit function. This is where we've been going at the entire time. Typically, we call this section only responsibility accounting because it's really its only purpose of being is to hold people responsible. There might be other reasons you determine the cost of inventory. For example, you want to know how much it's worth in case it's a part of a debt covenant or something like that. There are other reasons why you have a variety of the other tools that we've talked to up till now. At least that's the only argument I can say for really why we call this specifically responsibility accounting, even though it's just icing on the cake. So what you do is you need to separate your firm into responsibility centers. That's the typical thing that we do with responsibility accounting. We're going to say, all right, well, what decision rights do you have? And we're going to hold you responsible for those decision rights. Do you manage revenues? Do you manage costs? 2 separate questions. And we have a little flowchart we can build from that. If you control revenue, yes, and control costs, yes, then you are in control of the entirety of the profit function. That is to say, you have you have a material amount of control over revenue and a material amount of control over costs. Well, those are the two components of the profit function, and so we call that a profit center. Let's say you only control revenue. You control revenue, yes. You don't control cost, no. Then you must be a sales manager over a revenue center of some kind. Revenue centers are almost always some sales office or storefront where they don't decide how much the products cost to the company, but they do help decide how much gets sold. Their practices can influence and control in a material manner the revenue that comes in. And so you want to hold that manager responsible for the sales. So you're going to call that a revenue center. That's the name in front of center reflects what kind of decision rights are at that position or level. So we're almost always talking about an individual who manages a revenue center, the individual who manages a profit center. And of course, if you don't control revenue and you do control cost, then you're a cost center, or you're managing a cost center. So we're trying to hold that person managing this locus of decision rights responsible for the decision rights that they have. So we classify them either as cost decision rights, revenue decision rights, or profit decision rights. Okay, and of course, if you don't control revenue, you don't control costs, then you must be a professor. So, materiality and directness are important for answering these questions. Like I said, I was careful as much as I could anyway to include the word material in there. Sure, sometimes you're a cost center, but you do a little bit of work on the side, and you might have a small revenue stream that you control. That doesn't transform you into a profit center. If it's an indirect revenue stream, a small revenue stream, immaterial amount, then really you're probably just going to be held accountable for your cost center decisions. The magnitude of those decisions will impact whether or not it is economically necessary to hold you responsible for those decisions. It might just not be worth the trouble, not worth the cost benefit of holding you responsible for those decisions. Might not outweigh. The benefits might not outweigh the costs of doing it. Okay, so I think that's all really have to say there. Let's talk about service department cost allocations. So this will be the rest of the video. We're talking about this is the first of 3 different tools that we have in the responsibility counting area, as we call it in Chapter 10 here, to help make sure that the proper people who manage the decision centers we've talked about, responsibility centers we talked about, are held responsible for their decisions and the costs that they have incurred based on those decisions. So the first thing that happens is responsibility is hard to disentangle because it is often interdependent, especially since we're talking about larger scale firms who likely have a lot of very interdependent departments. What you ultimately are trying to do is make sure that the manager who does poorly can't say justifiably, "Oh no, it wasn't my fault, it was them over there." Well, you're trying to make sure that the interdependency between this department that you're talking about, this person who did poorly, and the department that they're trying to blame has been accounted for as much as possible in the accounting system. We're trying to allocate here. You don't want to go into a performance review and have them say, "Oh well, no, it was because Mercury was in retrograde." No. Okay, let's not do the excuses. Let's get responsibilities straightened out here. And if there's interdependency, then we have to sort that out. So we're going to segregate our cost centers into service departments and production departments. That tends to be what happens in this when we use this particular tool. Service departments, very, very classic examples are like the maintenance department, power department if you are producing power within your firm or managing power, the accounting department, information technology department, if accounting and finance are separate, finance department. These are departments where they're really just providing a service to the production department, which is the actual meat and bones of the value stream or of the products that are being sold to customers. The service departments are kind of producers to a customer within the firm, to production departments within the firm. Now, we're not talking about production departments that produce something then pass it along to the next production department. No, typically you account for that using transfer pricing, which is another one of the tools that we're going to talk about later in this chapter. We're talking about service departments that really don't have often anyway, they don't have a tangible benefit that they pass along in a very linear fashion to one production department. Often they're on an on-call basis, or they produce some sort of less tangible input. So it's not quite the same as Department A produces a widget that then Department B refines into a finished product. Those are two production departments. I'm always going to tell you which ones are which in my problems, and often if you are in practice, there will be some sort of rule of thumb that's been used or some sort of industry standard for which departments are which. Or I don't know if I've ever heard anybody complaining that this is hard to determine which are service departments and which are production departments. It's relatively clear in most cases, I think. So what happens is we have some interdependency. So when you're a service department, again, you're producing a good for customers inside of the firm. And the key that's going to determine what kind of technique we need for our service department cost allocation is going to be the interdependency not between our service department and our production departments. That's given. That's in the name that they're service departments. That's just assumed. It's the interdependency between service departments if they are serving each other, which is very common, especially in a large firm. Like I said, you're divvying up decision rights, and if you're going to have a firm that has this locus of core competencies in, say, maintenance, then they certainly are going to be helping the production departments, but probably also helping IT. You know, when IT has problems with their circuit breakers, the maintenance department's going to go over and help them too. They're going to help maintain the building the building and the offices where the accounting department works, and so on and so forth. The power plant maintenance is going to be required a lot there. A lot of important machinery that needs to be maintained and kept up to date and checked and repaired when necessary. So you have service departments that are serving each other, and that's interdependency. If there is no interdependency, then every method will give you no interdependency between service departments. In fact, for the rest of the chapter, I think I'm just going to talk about interdependency as meaning between service departments, that service departments are serving each other. If there is no interdependency, each of the three methods of service department cost allocation will give you the exact same answer. They're just allocating these costs for the service department to the two production departments, or however many production departments you have. They will all give you the same answer as a result of that. It's when we have this interdependency that now the three methods start to diverge. And we have to make a judgment call based on how much interdependency there is to determine whether or not it's worth it to do some of the more advanced and the more difficult methods. So the first method is the simplest, and it is the direct method. And we basically assume that there is no interdependency. So here's what actually the interdependency is. So service department 1 serves it. So its row is going to sum to 100%. It serves service department 2. At 20% of its work goes to service department 2. 35% of its work goes to service department A. Production department A, 45% of its work goes to production department B. That sums to 80% plus the 20%, 100%. Great. So its $100,000 of costs from service department 1 is due to services it's rendering to service department 2, production department A, and production department B. In the direct method, we're going to zero out these. And you can't just put 0 here because then we only have a sum of 80%. We've got to reallocate these to make them sum to 100%. And so what we do is we put 35% out of 80%, gives us a new percent, 43.75%. 45% divided by 80% gives us 56.25. Now, I've already expressed the interdependency in a percent term, as percents. You might find problems, or in reality, of course, in practice, it doesn't arrive as a percent to you. It will be service department 1 is the maintenance department, and its services are counted in terms of department hours spent, labor hours. And service department 2 consumed 200 of those hours. Let's just say service department 2 consumed 200 hours. Production department A consumed 350 of those hours. Production department B consumed 450 of those hours. So in total, service department 1 had 1,000 hours, 200 from service department 200 given on behalf, 200 for services given to department 2, 350 for department A, 450 for department B. And so you would then have to divide those. 200 divided by 1,000 equals 20%. 350 divided by 1,000 equals 350, or 35%. There we go. 450 divided by 1,000 equals 45%. So you get the percents by dividing the raw numbers. I just cut out that step here. I've given you the percents from the get-go. So anyway, under the direct method, you ignore the interdependency of service departments serving each other. There I've highlighted those cells. And then you have to reallocate these so they still sum to 100%. And then you simply take the costs and multiply it by these percents, and you move those costs over to the production departments that are affected. And so in the direct method, you are going directly from service departments to production departments. You are ignoring any service-to-service interaction or interdependency. It's relatively straightforward. It's also the least accurate. You end up with ignoring the fact that, whoa, more than a third of this $500,000 was not to any production department. It was over here to service department 2. Now, excuse me, service department 1. Yeah, here we go, to service department 1. Got to circle the right things with my mouse. So how would that affect things? What we're not accounting for is the fact that, under normal circumstances, under the direct method, look here, 92% of service department 2's costs are going to be given to production department A. Okay, that's not a full picture, because a third of that $500,000 is due to service department 1, and service department 1's work went much more evenly. In fact, the biggest consumer of service department 1's work was production department B. So a good portion of this $461,000 that we're pushing over to production department A is actually due to service department 1, which in turn used that cost to help it give services to production department B. So we have skewed the numbers a little bit. We've removed any indirect kind of flowing of costs with the direct method, and as a result of that, it's least accurate. It's often it's good enough for our purposes. Often it's just fine, but it's going to be the least accurate. Just if there's any interdependency, it'll be least accurate. Okay, so the next method is the step-down method. And so we're going to talk about stepping down. We're going to talk about service departments kind of stepping down like a waterfall, like water. Water flowing down the steps, or a slinky going down steps, or whatever. And I think it's important that you visually think of it stepping down. Sometimes it's called the step method. I like the idea of stepping down because, the water doesn't flow uphill. Slinkers don't flow uphill. I think it will help you do the problem right. So if you have the top step service department, you're going to be allocating your costs to all production departments like normal, but you're also going to go ahead and allocate your costs to the other service departments. If you're further down step, you will still be allocating to production departments as usual, and then you will be also allocating to any down step service department. So department 2 here will go to department 3. If you are the furthest down step, you are basically doing the same thing as we did under the direct method. You're only going to the production departments. Now, how do you determine which one should be the top and bottom step? And there I've read a couple different ways of doing this in various textbooks. I think the most common is to say, well, which service department serves other service departments the most, and just order the service departments like that. Take the one that serves serves other service departments the most and put it up top, and the second most, put it second, third most, third, and so on and so forth. If you have 20 service departments, rank order them like that, either going by percents or going by dollar amounts. And so what we do is we have our first step. We've decided that we're going to, that service department 2 serves service department 1 much more than the opposite arrangement, service department 1 to service department 2. And so we're going to make our first step service department 2. And so it's going to take its $500,000 and it's going to move it off of these raw numbers right here. We're not going to change them at all. The top step just uses the numbers that you're given, the percents for all of its services, because it has no limitations as to what it does. Water can only flow downhill from it. And no limitations. It goes to all service departments that it serves, and it allocates costs to all production departments that it serves in proportion to how much it serves them. And so that $500,000 gets divided up into $175,000, which is 35% of it, going to service department 1, and $300,000, which is 60% of that $500,000, going to production department A, $25,000 going to production department B, which is $5,000 of that $500,000. That's our first step. Now, we are not. The reason why I'm in this spreadsheet, and as I'm telling you, dividing up into steps, is that you have to do something. Service Department 1 literally got debited to it $175,000 more than what it had in debits for expenses already on its books. So you have to add that in. So that $100,000 plus $175,000 equals the new Service Department 1 cost of $275,000. I've seen people miss this step. It's painful to watch. But they will assume that, I'm just using Service Department 1's costs. No, those aren't the costs anymore. It received all the upstream costs. If we had 3 departments, our Service Department 3 would be having all of the costs that came down from Service Department 1 and all the costs that came down from Service Department 2, and that would be its new costs that it's going to move to the production departments below it. Okay, so first you revise the costs for the service departments based on your previous step in the allocation. And then you go ahead and zero out any upstream or upstep allocations and reallocate the remainder of the percentages based on the percentages that are left. So we did that already. Because we only have 2 service departments, this percent is equal to what we did before. We have 2 service departments, so we have a top step service department, number 2, and we have only a bottom step service department, number 1. If you had a third one, then it would have the middle child, Jan here, would reallocate its percentages based on this service department and the production departments. It would form new percentages based on the denominator being the total work done by these 4 in this diagram right here. But we only have 2, so we have like a number 1 and a number 3, which is Jan got X'd out. Poor Jan. And so, losing my voice for some reason. We just have our last bottom step, which, like I said, when I went over that diagram in the first place, looks just like the direct method. So we are going to take this new number, just like the direct method, except that it has additional costs. We're going to take this new number and multiply it by our new percents here. So these numbers are not equal to what there was before in the direct method. See, our percents are the same, but the numbers that Service Department 1 is moving to those 2 production departments are not the same. It's much higher because we got all that Service Department 2 to Service Department 1 interdependency accounted for, or some of it anyway. I want to give some qualifier there because I won't call it a full accounting because Service Department 1 is also reciprocally helping Service Department 2. So some of that 35% is coming back and helping Service Department. It gets to be really messy when you think about it, which is why we have a third method. But let's not go there yet. Hold on. Okay, so the totals are different and they are more accurate. I told you we had too much we were pushing too much cost into Production Department A based on this indirect Service Department 2 to Service Department 1 relationship with this 35%. And so our direct method had $500,000 going to A and almost $100,000 going to B. And now we've changed that around, and now we have $420,000 going to A and almost $180,000 going to B. So we've shifted the balance a little closer towards B, getting its duly responsible costs from these service departments. The services it ordered, at least indirectly, are higher now, and it's going to be more accurate. Responsibility is going to be more fairly assigned that way. The reciprocal method. Now there are 2 ways to conceptualize this. One is algebraically, in which you solve a system of equations. You say Service Department 1 equals its costs plus 35% of Service Department 2. And you state Service Department 2 the same way. And if you had more, you'd state them the same way. But you end up with the number of equations, same number of different equations in the system as there are variables. That's perfect. That means you can solve it. And so you solve it out and you can end up with a new number. The other way to conceptualize it actually is just doing the step down method over and over and over again without any stepping down. That is to say, to just allocate this 500,000 based on these percents and then allocate this 100,000 based on these percents. And now you still have leftovers because this 20%, this $20,000 it would be going to Service Department 2 is still in Service Department 2's numbers. And this $175,000 is still in Service Department 1's numbers. And so then you do it all over again. Now with $175,000 going where this goes. And now $20,000 going where this percent sends it. And you do that over and over and over again. It gets smaller and smaller dollar amounts. And eventually you get to just cents. And you can round down to nothing. And if you did it over and over and over and over and over again, you would end up with the same numbers that you end up with here. Here you just solve it algebraically though, which is beautiful. The biggest problem that people have when they do this is either not wrapping their head around what's happening or messing up the algebra somehow. Usually it's a problem of picking the wrong percents. So here we're talking about Service Department 1's costs include its own costs plus the costs it consumes from Service Department 2. So not this 20%. No. We're talking about Department 1's consumption from Service Department 2. I've seen that happen. I've seen that, we're talking about Service Department 1, so I want to put 100,000 plus 0.2 Service Department 2. No, that's wrong. It's 100,000 plus what Service Department 1 consumes, which is in this column right here. If you've organized the table this way anyway. Okay, so if you set the equation right upright, and then what you do is you're simply taking this equation, one of the equations, and plugging them in for the other. So instead of this equation has SD1 equals all this plus SD2, you say, I can substitute the right-hand side of the equation for SD2. And so I'm going to put this, instead of saying SD2, now says the right-hand side of the equation. So now I have only SD1, and I can solve it out. So I just multiply this, distribute it, right? 0.35 times 500,000, and 0.35 times 0.2. Now I have it all together, and I can now move this amount right here over to here, and now I have 0.93 SD1 equals 275,000. So then SD1 must equal 295,699. I rounded it out. I do the same thing over here. Now I know SD1 equals this, so I can just plug that in right there, just using that same SD2 equation. Plug it in right there, and I end up with this amount right here. Now, that doesn't help us yet. What that tells us is if we did the repeated iterations that I said, if we just took these and just distributed them with these percentages over and over and over and over and over again until we got where we're distributing like cents on the dollar, cents, 35% of 20 cents goes here, 60% of 20 cents goes there, and we get it down to a small amount. The total amount that we would allocate would be this amount right here from Service Department 1, and this amount right here from Service Department 2. And so what we can just do is just take those numbers. I'm calling them allocation bases. I've seen that in a number of textbooks. I think that's a fairly common terminology for this. And we're just going to allocate those based on these percentages right here, and that will give us the right number, the full number. As if we had constantly shot these numbers back, these costs back and forth between the two service departments based on this 35% and this 20% over and over and over again. These are the amounts total that we would have been allocating. So we just do it once. So we end up with 35% of this 559 gives us 195,699. In fact, I made sure I highlighted the cell when I took the screenshot. We have B29, which is equals B29 times C25. So we have this 559 times 35% equals 195,699. Okay, and because we're allocating that over to Service Department 1, that ends up being the same amount that we are going to be allocating out from here extra. I hope that makes sense. Remember, we actually only had $1,000 of cost, $100,000 of cost in Service Department 1. So we're going to allocate just this amount extra over to Service Department 1 so it can do its full allocation. And we only had $500,000 in Service Department 2. We're going to allocate from Service Department 1 this much extra so it can do its full allocation. So these two, this right here cancels out with the excess here. This right here cancels out with the excess here. And then the amounts that go into protection departments are what we really want. And if you sum these, they equal 600,000, rounded anyway. A little off because of rounding. But these two together will equal about 600,000, which is the amount of cost that we're allocating. Hopefully that didn't throw you too far off. The reciprocal method is the most complex of them. The system will do it on its own if you have a good system for reciprocal method allocations. But that's often not good enough because we're talking about costs that are going to determine managers' bonuses, and they often want a little more explanation than the system did it. Yeah, that doesn't go over very well when they're wondering why they have this big line item of expense coming their way that suddenly makes their bonus go away. So it's a little less clear to explain. And that is indeed a cost. Perhaps it's minor. Maybe you got a bunch of geniuses in your firm and a bunch of people who are completely disinterested in their own compensation. I don't know how that would ever happen, but let's just assume you did. Maybe it's not that big of a deal. It's short PowerPoint presentation of how this works, and maybe it's a small cost. More likely, it's going to be a significant cost to explain this system when it comes down to the wire, or when it becomes an issue. Somebody takes issue and umbrage with what was done. Because if we'd used the direct method, we'd have been pushing $500,000, over $500,000 to Production Department A. So Production Department B's manager is happy with that. Ooh, the reciprocal method, though, pushes that up to $161,000. So Production Department B manager says, wait. Why am I getting so much more than it seems like I should be getting? I take 45% of that 100,000. I take 5% of that 500,000. Maybe they're even doing the math wrong because they're taking these percentages instead of these percentages. Even if they did take this 56%, I should be getting 94,000. Actually, it's because of interdependency and the math and the algebra. Yeah, you try explaining that to a manager who's upset about the service department allocation coming his or her way. That's going to be a fun conversation to have. But it is the most accurate. In fact, it fully, as insofar as our measures that make up these percents are properly tracking the interdependency between service departments, the reciprocal method has fully accounted for that. So now it comes down to whether Service Department 2's work for Service Department 1 was properly accounted for using labor hours in my example I gave before. Or Service Department 1, let's say we're tracking kilowatt hours for it. Let's say it's power department. Is kilowatt hours the best driver for these costs? Ultimately, this is a driver, and this is like an overhead allocation. And so there's some lack of precision that can happen there. And that's really all I have. Bye.